Could the crisis we are experiencing today, in fact, be worse than the 1970s? Some are saying that's the case. The first thing I want to discuss is the 1970s as well as the 2020s, some of the parallels there. The second thing is not just the crisis, but also the solutions. And the third is China's slowdown. I am seeing revision after revision from companies like Goldman Sachs saying the growth just isn't going to be there. I've got all of that and more. Let's go. Day after day after day, I'm seeing articles like this. Paul Tudor Jones says inflation could be worse than feared, biggest threat to the markets and society. Is stagflation coming back? Economists sees parallels with the 1970s. Also some differences, of course. Then we have this, a stock market malaise with shadow of 1970s style stagflation. But that brings me to this point. Port snarls could be worse than the Lehman crash, according to the Flexport CEO. And this is the focus for today's video. We'll get into that more in exactly what he said in just a moment. But I need to bring you a few angles of this before we get into it. Peterson says the port shutdowns could be catastrophic, and they discuss what could be done. So in that, the solutions will come. I will talk to you about this in a moment. Yellen expects high inflation through mid-2022 before easing. That's right. Yellen, who had said she would never see another crisis in our lifetimes, and here we are. Have no fear, though, because they haven't lost control. Rejects the criticism that U.S. has lost control of rising prices. If you remember, Larry Summers, the former Treasury Secretary, had said that they've lost control. But here, the current Treasury Secretary says, oh, no, that's not the case. What they have done recently has pumped in a whole bunch of money, whether that's coming from quantitative easing or directly from the government, stimulus packages, all of these different types of stimulative effects eventually makes its way into inflation, price inflation that is. Take a look at this. Copper's wild week throws spotlight on the straining world economy. This is just one commodity, of course, a very important commodity, but you look at how many. I might show you oil tomorrow, and today it's copper, and the next day it's corn and wheat. And yes, we can highlight one particular point for that one particular commodity, but it's everything. Copper is caught between tight supplies and demand worries. Global stocks are under pressure even outside LME warehouses. This is an issue that I talked about recently, okay? The London Metal Exchange, they had some issues, okay? What do you do when there's no metal at the London Metal Exchange? You run into some serious problems. Copper inventories have plunged on the major exchanges. Just to give you an idea historically, because I can throw out a number that may not make any sense to people. Okay, it's 1 million, it's 500,000, whatever. But seeing it in the context of history gives us a better view, doesn't it? So that is here on this Bloomberg chart. What about this? Palm oil surges to fresh all-time high on edible oils shortage. So many different circumstances like this, one after the other after the other. So the point here is that we are seeing prices that you, the individual, have to pay increasing at a pace that is not corresponding to wages. That's pretty obvious. Even though some people are getting those wage increases, the prices are just rising so fast. So here, we are going to get into this. Sit back in a cozy chair. I'm going to bring you the information you need. And further down, there are some solutions that I will talk about. But as always, the links will be in the description. You can get all of this information and look at it in depth. If you appreciate that, don't forget to hit that like button. Ryan Peterson. Yesterday, I rented a boat and took the leader of one of Flexport's partners in Long Beach on a 3-hour of the port complex. Here's a thread about what I learned. Okay, I'm not going to get to all of it, of course, but quite frankly, I need to cover a bunch of this, okay? This is really key. He really gives a good perspective. This is somebody in the industry talking about what he is seeing. The ports of LA Long Beach are at a standstill in a full 3-hour loop through the port complex, passing every single terminal. We saw less than a dozen containers getting unloaded. That right there, I mean, I'm not in the industry. I do logistics somewhat, but nothing like this seems normal. That just doesn't seem normal. And coming from a person like this, okay, it's making a lot of sense. That isn't normal. There are hundreds of cranes. I only counted approximately 7 that were even operating, and those that seemed to go pretty slow. It seems that everyone now agrees that the bottleneck is yard space at the container terminals. Okay, this is the CEO of Flexport telling you the bottleneck is this. It seems that everyone now agrees that the bottleneck is yard space at container terminals. The terminals are simply overflowing with containers, which means they no longer have the space to take in new containers, either from the ships or land. It's a true traffic jam. Right now, if you have a chassis with no empty container on it, you can go pick up containers at any port terminal. However, you have to empty the container on that chassis. You're not allowing you to return it except on a highly restricted basis. If you can't get the empty off the chassis, you don't have a chassis to go pick up the next container. If nobody goes to pick up the next container, the port remains jammed. Do you see what's happening here? It's a true bottleneck. Now, there could be other factors. Yes, I get it. This could be, something, they were saying the lazy crane operators not moving fast. I don't know. I'm not there. I can't confirm that. But this is something important, okay? So stay with me. Yards are so full, carriers and terminals are being highly restrictive in where they're accepting the empties, and it goes on, okay? Look at this. Trucking companies, talking about the containers off the chassis. There's zoning codes. This is right. This is what I want to talk about. He can't take the containers off the chassis because he's not allowed by the City of Long Beach zoning code to store empty containers more than 2 high in his truck yard. If he violates this code, they'll shut down the yard altogether. Interesting. 2 high, right? Okay. Depending on where you are. That rule only applies depending on where you are. And with all the containers piling up the terminal yard, the longshoremen can't unload the ships, and so the queue grows longer. There's over 70 ships containing 500,000 containers waiting offshore. The line is going to get longer, not shorter, and this is huge. This is a negative feedback loop that is rapidly cycling out of control, and if that continues unabated, will destroy the global economy. I'm not saying that. This is the CEO of Flexport. All right, how do you fix it? These are the solutions. If you appreciate me getting into the solutions, you want to know about this, hit the thumbs up button, okay? I try to bring you everything from all angles. Look at it. When you are designated an operation, you must choose your bottleneck. If the bottleneck appears somewhere that you didn't choose, you aren't running an operation, it's running you. You should always choose the most capital intensive part of the line to be your bottleneck. In a port, that's the ship to shore cranes. The cranes should never be unable to run because they're waiting for another part of the operation to catch up. Makes sense, right? The bottleneck right now is not the cranes. It's the yard space at the container terminals, and it's empty chassis to come clear those containers out. In operations, when a bottleneck appears somewhere that you didn't design for it to appear, you must overwhelm the bottleneck. Essentially, what are they saying? Okay, look at it. They want to override the zoning rules in Long Beach and LA to allow truck yards to store empty containers up to 6 high instead of the current limit of 2. Make it temporary, let's say, for 120 days. This is going to allow a little bit of breathing room. Bring every container chassis owned by the National Guard and the military anywhere in the US to the ports and loan them to the terminals for 180 days. Create a temporary container yard, a piece of government land adjacent to an inland rail. Make it happen. Do that. Force the railroads to haul all the containers to this new site, turn around and come back. No more 1,500-mile train journeys to Dallas. We're doing 100-mile shuttles, turning around and doing it again. Bring in the barges, small container ships. Start hauling containers out of Long Beach to the other small ports. He's giving solutions. What do you think of this? Let me know. Okay. In addition to that, we've got this. Flexport says Trans-Pacific is deteriorating, brace for a shipping tsunami. So all of this, okay, all of this to say what's happening is going to get worse unless something changes. That's what I wanted to say. Right now, this is big, and in fact, it's huge. Let's break it down a little bit right now in the Money GPS Insights. In addition to the supply chain problems that we have today, we have a historic amount of money that has been printed. Put these two and two together and you've got a problem we have never seen before. On top of all of that, we have speculation from the retail side, retail investors that have gone into levels, quite frankly, that this is just unheard of. And on the Federal Reserve's end, they have no other option but to create an endless stream of worthless fiat confetti. I just wanted to cover this really quickly to show you what has happened out of Bloomberg first, and then we'll show you Goldman Sachs. Chinese economy risks deeper slowdown than the markets realize. Property downturn seen as biggest threat to GDP growth. This is a market that is worth $62 trillion. The Chinese real estate market, $62 trillion. It's huge. Obviously, you've got massive counterparty risk. That's key to understand, and we'll talk about that more in just a second. I don't know if they get into it here, but certainly I did cover it at one point. I will show you that. But you've got problems, okay? There's no doubt. Contraction of construction and real estate services in the third quarter that has gone into the negative, okay? Why? Because they're worried about Evergrande. They're worried about all the property developers. They don't want to, make anything happen right now. Let's hold off. At the same time, as they mentioned on the right-hand side, PPI inflation has reached a record high in September. So all the input costs are too high. So they're concerned on one hand, and my goodness, they've got some serious price pressures on the other. Looking at this, property tightening, power cuts, effects in September's data, and you could see not looking good for many of the factors here, okay? They just break it down, infrastructure, property new starts, everything all together, just showing some serious weakness there. And on the right-hand side, output gap has turned negative in Q3. That's China's output gap, short term versus the long term. Not good right now. Contribution of housing to year-over-year GDP growth has turned negative in the third quarter. So many of the factors here turning negative. While their GDP itself might be growing, it's not necessarily, when you break it down and look at it at a different level, it just shows weakness. We revised down our 2022 GDP growth forecast to 5.2%. They brought it down and they brought it down again and they brought it down again, and just constantly bringing this down. And why? Because there's just the addition of new things every day. Is it Evergrande? Is it Cynic? Is it Fantasia? Is it all these different companies that are having problems? Whether or not they default or whether or not they're, have to restructure their debt, it's looking weak all throughout. And China is the engine of the entire world. Their consumption of everything that the world can offer them is like no other country. They are a consumer of basically everything more than all other countries, and sometimes combined. Take a look at this. This is referring to countries, they get into a few of them, Indonesia, Philippines, and Vietnam, essentially saying they've got to shut down their coal plants and move over to something better, green alternatives as they call it. And what is the plan? Well, the Asian Development Bank, which I'm not mistaken, China is the sort of controlling that. But anyway, looking at this, it just basically says, we want them to speed up, even though they have very new coal plants. They say, speed up the process, shut those down, and we are going to give you some cash to do that. And that just shows you what their plans are and how quickly they want to move out of something like coal into something that is more, as they say, green friendly. The reason I mention this is, as an investor, you got to keep this in mind. Trillions of dollars globally is going into this so-called green energy. Who knows what it is? Just like ESG. Okay, environmentally friendly funds. Is it really environmentally friendly? It depends. Some of them are, some of them are not. Look into it very carefully. But all I'm saying is this is where the money is going. This is where the money is going. Keep your eyes on it. And I think it will be very important in the future, the near future, as well as right now. Okay, that's it. If you support the channel, hit that thumbs up. If you want these videos to come up in your feed, your recommended feed, just hit that thumbs up button. You got to subscribe, click the little bell, and make sure it says always notify me. This is so important. Okay, every day I get people telling me, I've been unsubscribed from your channel. I've been watching your channel for years. I've been unsubscribed. So make sure you click that bell and make sure that it says always notify. Okay. And if you haven't seen this video yet, you definitely want to check it out. Click it and I'll see you there.